Hi, everybody. Welcome to the Technical Accounting Update provided by RGP. And I'm Janis Parthun. I'm here today to be providing and highlighting some of the regulatory and standard setting developments. And a little bit about myself. My background is in the finance, accounting, and risk management, as well as driving continuous improvement for clients. I currently lead initiatives around thought leadership and service innovation development on emerging and finance and risk issues. I'm also the ESG reporting services leader at RGP as well. And a little bit about RGP. RGP is a global consulting company that serves over 2,200 clients, which includes 88 of the 100 Fortune 100s. RGP enables rapid business outcomes by bringing together the right people who together create transformative change and daring to work differently to deliver the future of work today. Now, just wanted to share a little bit of disclaimer. The views expressed in this presentation are those of mine, and it does not necessarily reflect the views of others, and that these slides are really for educational purposes only and is not intended to be relied upon for accounting, tax, or professional advice. So for today's agenda, what I wanted to talk about is just a little bit of background on the AICPA and the CIMA conference, because a lot of the information stems from that, as well as the regulatory and standard setting developments, highlights of some key topics, and then at the end, wrapping up with a PCAOB update. Before we start, we have our first polling question. Which organizational function do you currently represent? Finance, internal audit, legal, audit committee member or board, or other? Just so that I have a little bit of background understanding for our audience here, which organizational function do you currently work in or consult in, things of that sort. And then we'll just give a little bit of time so that we can see the response. Oh, great. So we have a large percentage of you in finance and internal audit, and then some of you representing from the other category. All right. Thank you for answering that. Now, to provide just a little bit of background on the conference, this is the national conference that started in the 1970s. Believe it or not, it's been going on for quite some time. And it's an annual conference where the key stakeholders gather to discuss updates on the latest accounting and reporting issues affecting the SEC registrants and auditors. And this, the sessions from the conference was held back in December recently last year. And I just want to emphasize that this presentation doesn't necessarily include all the topics that are covered, but it includes some of the highlights that we've discussed from the speakers as well. All right. So stepping into regulatory and standard setting developments. So before I dive into the developments and updates, I usually like to just start providing background and clarity in terms of the different SEC divisions and offices and their objectives. And really just having to reference the specific groups later on as I go through the presentation. So it's helpful to provide that. Now, ultimately, the SEC role is to protect investors and facilitate market formation, but this also includes having oversight responsibilities with the standard setting bodies, which includes FASB, and because SEC has the power to enforce with the public companies. And so, but this responsibility also in turn impacts the private companies as well as the nonprofits having to have responsibilities, overseeing FASB. So I tend to start with the SEC and what they're doing as a starting point, but I'll also cover aspects from FASB's perspective as well. Now, the OCA provides consultation on the accounting, financial reporting, auditing concerns and questions, especially those that are typically unusual or complex or innovative. And there's not necessarily any clear authoritative guidance that exists around these. And then you have the DCF, which then they oversee the corporate disclosure compliance with the securities laws and regulations. And they are also required to review each company filing every 3 years as required by Sarbanes-Oxley Act. You know, many times companies don't necessarily hear from the DCF, and it just means that they reviewed their filing and it was fine. But if they receive some sort of correspondence, that typically means that they have some issue with how they have filed their reports or financial statements. And this is where the SEC staff provides comments in response to the company filings, and they're often referred to in the correspondence as comment letters. And then now, if a company has conducted something that is misleading, there's also the Division of Enforcement, which then conducts investigations into possible violations of the federal security laws. And then the DOE prosecutes for the commission civil suits. So I just wanted to initially share this background before we jump into some of the updates coming up. Now, with the SEC's rulemaking activities, I like to just highlight a few noted here. In terms of the final rule, you have the recovery of the erroneously awarded compensation, and this is a rule to establish the listing standards that would require listed companies to adopt and comply with the compensation recovery policy should a company's financial information need to be restated. This was open for public comment and finalized late last year, and it's currently effective starting January of this year. I also wanted to point out that the SEC proposed a number of rules in 2022, quite a bit, but the organization also ran into a system issue and didn't receive all their submissions. So the comment period was essentially reopened through November of last year for 12 of the proposed rules. And I just want to at least bring attention to 3 of them here. I mean, there were 12, there were quite a bit that were reopened, but in terms of the relevant ones, I wanted to call out these 3 here, and then discuss later in the key topics session as well, as these really have significant impact. You can see the cybersecurity, the climate, and SPACs. So you want to be on the lookout for these future developments, but I'll cover these in the key topics area too. All right, now transitioning to the standard setting perspective, I wanted to highlight some of FASB's activities. So FASB had issued an invitation to comment back in 2021, which then really helped shape the board's priorities and projects. And now there are currently multiple projects on FASB's technical agenda, and I'll provide a list in terms of the recently completed projects in the next slide, but I want to just highlight a few here, and then I'll discuss further under the key topics as well. So one I want to talk about is the liabilities on the supplier finance program. And the focus here is on the disclosure of the supplier finance program obligations, or subtopic 40550. And the intent here is to have the buyer party of the supplier finance program or programs provide additional disclosure information about the use of the program and to understand the effects of the program on the entity's working capital, liquidities, and cash flows. So the supplier finance program allow a buyer to offer its suppliers the option to access the payment in advance of the invoice due date, which is paid by another third-party finance provider or intermediary, and on the basis of the invoice that the buyer has confirmed that's valid. So this update is really to enhance the transparency about the use of the supplier finance program, which includes disclosing some of the key terms of the program and the balance sheet presentation of the program obligation applicable to the buyer parties. Now, the other one is segment reporting. Thought it would be important to call out. And in the segment reporting, it's currently in exposure draft phase, but the objective of this project is to improve the segment disclosures to provide users with more decision useful information about reportable segments of the public entity. And the improvements include disclosure of the significant segment expenses, expanding interim period requirements, allowing disclosure of more than one measure of the segment profit and loss. And then this also applies to single segment entities. So the exposure draft was issued late last year, and FASB is now evaluating the comments received up to December last year. So you really want to stay tuned on this one. And then in terms of the IASB, Andres Barcal, the IASB chair, shared his thoughts on 3 new projects. The standard on intangible assets. So the standard's been more than 20 years old, and it was written with a different objective in mind. So it was time to take a fresh look and began the research for IASB. Now, in terms of the standard for the statement of cash flows, they also need an overhaul since the guidance lacks details around non-cash transactions to consider, and it's also determined impractical for certain industries. In terms of the climate-related risk, the interest here is that they wanted to have a chance to review and determine if the recent requirements that's been issued by the IFSB is linked to and aligned with the general reporting requirements in IAS 1. So there's these 3 projects that the IASB is currently focused on, and really having to explore that and investigate that a little bit more. Now, in the last segment of the agenda, I'll be providing a summary update on the PCAOB aspect of things. And as I mentioned earlier, these are the list of the completed projects that FASB issued, the completed ASUs. And as of yesterday, when I had looked, there haven't been any new ones that's been released, but these are the completed ones as of yesterday. So for the FASB updates from 2022, FASB completed 6 projects and published the ASUs here. And I'm just providing this list just for awareness and really just highlight briefly on each one of these. So in terms of the fair value hedging portfolio layer method, this applies to all entities that elect to apply the portfolio layer method of hedge accounting in accordance to Topic 815. And for public companies, this is effective starting this year, 2023. As noted here, I have in the column. In terms of the troubled debt restructuring and vintage disclosures, this update is really a result of a post-implementation review since the issuance of Topic 326 and the outreach that's been conducted. So the the amendments really essentially eliminate specific subtopic guidance on the troubled debt restructuring by creditors and provides the direction to reevaluate the troubled loan as new or existing, as well as disclose the current period gross write-offs by the year of the origin of the financial statements. And this update is also effective starting beginning of this year. Now, the fair value measurement of the equity securities subject to contractual sales restrictions. This update is essentially clarifying that contractual sale restrictions on the equity security should not be considered in the fair value measurement, but to include in additional disclosures. And this update is effective for fiscal period beginning next year, 2024. And then we have the disclosure, the supplier finance program obligations, which I just highlighted earlier. And then there were 2 that were recently issued in November, so it's fairly recent. You have the transition for sold contracts for financial services, specifically for insurance. And this update allows an entity an entity elect to exclude contracts that meet certain criteria from applying prior amendments in the update 2018-12, such as the sale or disposal of contract or legal entities, and it's effective starting this year. And then lastly, the reference rate reform, and it's the deferral of the sunset date of the topic, essentially moving the sunset date from 2022 to 2024. So, and then of course, last, just a reminder on lease accounting. Lease accounting became effective last year for private companies, and so we have lots of resources around that with lease accounting, with the link for the RGP on the RGP website. Okay. So with that, I'd like to start highlighting some key topics that were discussed quite a bit at the conference and provide a high-level summary of each. I think we have our next polling question here. So with that, which topic is of significant interest for you this year? Is it segment reporting? Is it digital assets? Is it ESG, cybersecurity, or other? So I'd be interested in seeing the audience perspective, what topic is of interest to them or to you. Give it a little bit of time. Okay, great. So we have quite a bit audience of interest in ESG, which I will definitely cover there. Digital assets, I will also cover, as well as cybersecurity. So I will touch upon cybersecurity, not necessarily to the full extent, but I will touch upon that topic as well. So great. All right. So with that, so ESG, the first topic that I want to highlight and elaborate is ESG reporting, which stands for environmental, social, and governance. Now, the topic is not new, and there are significant funds and investments around this. If you see here, over 96% of the SP 500 voluntarily publish sustainability reports in some form or fashion. Over 150 billion in net new money generated in 2022 internationally focused on sustainable funds. 370 billion in investment is targeted for emissions reduction and promote green technology based on the Inflation Reduction Act of 2022. So you can see there are just significant interest to invest and report. And then you have proponents saying that a company's ESG efforts may influence how they may purchase or invest in that company. And companies want a way to share how they're acting responsibly with their employees, their customers, their suppliers, and the environment. But then there are also critics, such as the ESG ratings developed that rank companies by how they're performing on ESG factors, which has created frustrations for some companies. And the other aspect is the question of the fund or the investment product labeled with ESG. But because of the wave of the activities, regulatory and standard setting bodies are really paying attention. So to dive into this topic, there are developments on multiple fronts. We'll first start with the financial statements. Related to the financial statements, the SEC has already issued an amendment that requires businesses to include human capital disclosures that became effective late 2020. But in terms of proposed rules, the SEC has two, one applicable to the registrants subject to investors, and then the other directly applicable to the investor community. Many people have been talking about the first proposed rule, and I'll elaborate more in the next slide. With the second one, the ESG disclosures for investment advisors and investment companies, the goal of the proposed rule is to determine whether a fund or advisor's ESG marketing statements represent concrete and specific measures taken to address the ESG goals and portfolio allocation. The proposal requires that investment companies and advisors too disclose their ESG strategy, present in a tabular format for easier comparison across different funds, and for environmentally focused funds, disclose your emissions associated with the portfolio investments. Now, switching to or transitioning into standard setting perspective, we have the accounting for environmental credit programs. And this is on FASB's agenda to assess requirements for participants in compliance and voluntary programs that have led to the creation of environmental credits. And the credits may include the credits created under the compliance programs, such as the cap and trade and baseline allowance programs, or essentially the emission trading involving federal and regional programs. You have the renewable energy credits and certificates, renewable identification numbers, carbon offset credits. And this project will also evaluate the financial reporting requirements for non-governmental creators of environmental credits. For example, such as hybrid vehicle companies. Really, the focus is on credits that are enforceable and traded, so it doesn't pertain to the tax credits or investment related. And the topic initiated because of the diversity in practice without much strict guidance, such as whether the transaction should be accounted for as inventory or finite-lived intangible assets when purchased. But it's still in the initial deliberations at this time, since this is a new project that FASB started. The other research project is the accounting for financial instruments with ESG-linked features, since many have had challenges applying the guidance on derivatives. And for example, when the bonds have interest payments that vary based on sustainability-linked metrics. So you want to stay tuned on this one because if it gets moved into the agenda for standard setting. Right now, it's just in the research phase. So in terms of climate risk, I think as many of you may already be aware, March last year, the SEC proposed rules to enhance and standardize the climate-related disclosures as the investor community is demanding for more consistent, comparable, and reliable information across companies. The proposed disclosure specifically on climate-related risk would require public companies to disclose details to specific contents when submitting the filing, such as registration statements or annual reports depending on the timing. And this includes having to include oversight and governance, material impact on the business and future outlook, process to identify and assess and manage the risk of greenhouse gas emissions, impact of possible climate-related events. And this includes disclosing financial impact when summed together cumulatively greater than 1% of a significant line item on the financials. Details on climate-related targets and goals, and then other information such as scenario analysis. This also means that information disclosed would need to be tagged in XBRL and subject to SEC's rules and disclosure controls and procedures. Now you can see here for larger organizations, for the accelerated and large accelerated filers, there's the additional requirement to obtain reasonable assurance on the Scope 1, Scope 2 emissions, and then a phased approach for implementation. Now, the elements that's been most sensitive for registrants or causing stirs and lots of responses to the proposed rule, it really are the limited and reasonable assurance requirements, estimating the financial impacts to the possible climate-related events, and reporting Scope 3 emissions has been a major concern for companies. Now, I've included the proposal here, and we also have a RGP blog if you'd like to learn more details about that, as well as the proposed rule link. And I think with many of us, we'll be monitoring this very closely, but I would say anticipating that SEC may come out with a decision in March or April. But right now, It's just more of an anticipation at this time. All right. Now, on the international front, the IFRS Foundation created the International Sustainability Standards Board, ISSB, focused on sustainability-related disclosures to help investors make informed decisions about ESG matters. And the exposure draft issued includes general sustainability-related disclosures, setting out for overall requirements for the entity to disclose, and climate-related disclosures. The ISSB is currently targeting to issue the final standards by mid-year this year. And when the ISSB standards are officially issued, they're not mandated unless the country or the jurisdiction authority decides that the company should comply. But interesting enough, the shift towards compliance is also starting to happen internationally. You can see here, I've listed a number of them, and I will just briefly highlight that you have the UK, have the Streamlined Energy and Carbon Reporting, or the CCAR, which requires public companies to specifically disclose UK annual energy use and emissions applicable starting 2019. You have TCFD disclosure requirements, which requires public, large private, and certain LLP companies to incorporate TCFD-aligned climate disclosures in their annual reports. And this was applicable starting last year for organizations over 500 employees. The EU recently adopted this new rule, which is the Corporate Sustainability Reporting Directive, for companies to publish detailed information on sustainability matters to increase the company's accountability and to prevent divergent sustainability standards, effective starting in 2024. However, the European Financial Reporting Advisory Group, or EFRAG, are responsible for developing the draft European standards. And right now, it's really currently it's been out for exposure draft and receiving the comments. And so the advisory group is assessing and reviewing the comments at this time. Now, the last note here that there are other standards and frameworks out there, such as FASB and GRI, that provides guidance to address the sustainability or impact reporting, separate from the reporting of the financial statements. Okay. So with that, now we're going to transition into digital assets. And the other hot topic here, of course, is the digital assets. But before I go into detail on this, I just thought I'd provide a little bit of intro, and I liked how NASDAQ explained these assets here. So I have a list of them here, just wanted to highlight. You have cryptocurrency, which is the digital currency that's secured by cryptography via blockchain technology. Excuse me. And the technology really is to securely record the information that cannot be altered. And this is used as a form of payment or investment. And Bitcoin or Ethereum tends to be the examples of what people hear about. You have the asset-backed tokens, which is physical assets that can be tokenized and traded among the users on the blockchain through the usage of asset-backed tokens. And tokenization of these assets can help on liquidity problems with the assets, such as gold, oil, real estate, and those are just some specific investment examples. You have non-fungible tokens, and the asset token is unique and allows for authentication to prove that the token is real, specific to the owner. And there's been a number of artwork or media recordings that's been sold as NFTs. And then interesting enough, there's also the central bank digital currency, which is a digital form of a country's fiat currency, or if it's government issued. And it's issued and regulated by a country's monetary authority or central bank. Some of the foreign countries have this, like Bahamas, Jamaica, and China's launching. Now, as the digital asset transactions increase and fluctuate significantly, the risk and volatility associated and the high transaction volume has triggered enough concern that March last year, the White House also issued an executive order for multiple agencies to review and investigate and determine solutions to ensure responsible development of digital assets. This includes exploring CBDC for the US. And according to the White House, non-state issued digital assets reached a combined market cap of $3 trillion. The White House and the Congress are also stepping in to pull multiple agencies involved to figure this out. Now, starting from the SEC's perspective, the SEC had shared, certain fraud and investment scams related to crypto assets have increased. And the big one that recently occurred, as you may have heard of, is around the executives from the crypto asset trading platform company, FTX, charged with fraud and with FTX in bankruptcy due to the leverage and solvency issues. The SEC has been communicating on the crypto asset topic, but more specifically to entities who are custodians of crypto assets or exchanges that facilitate crypto asset trading, and by case basis for other situations. Now, at past conferences, the SEC has reconfirmed registrants should be accounting for cryptocurrency under intangible assets and have elaborated more across different scenarios. But I would say companies don't necessarily like this approach as much, since you have to assess the impairment at least annually. And then at times you can't necessarily recognize the value increase until you sell it. Well, in April last year, the staff issued FASB 121 to provide firms that offer custodial services to crypto assets the direction on how to record these custodial services on their financial statements. So specifically, entities who safeguard crypto assets held for their platform users. The guidance recommends firms to record a safeguarding liability and a corresponding asset separate from the underlying crypto asset at the fair value. I want to add that at the conference, the SEC emphasized the importance of having the terms and conditions clearly disclosed to enable the users of the financial statements to understand the rights of the crypto asset holder and the obligations. And then bring in the specialists, such as with technology or law background, as these arrangements bring audit complexity and you really want to consider the various risks. And as mentioned earlier on the FASB developments, digital asset was the #1 interest that FASB received from the agenda feedback. And so with the heightened attention from the SEC, the result is that the FASB is moving ahead with accounting for and disclosure of digital assets, and to improve the accounting and disclosure for the subset of the exchange-traded digital assets, as well as exchange-traded commodities. But FASB would also like to reevaluate what makes sense for commercial companies, because the plan is to initially propose the entities to measure certain specific crypto assets at fair value, and it's approved to prepare an exposure draft as next steps. In terms of other guidance, the AICPA issued a practice aid back in 2021, and this is the form of a Q&A, which I think could provide some insight in the interim if your organization is handling or in receipt of digital assets. At a highlight, and according to ASC 350, entities should determine the useful life of an intangible asset, and if purchased for cash, for initially measured at cost. But if this is a contract with a customer for a digital asset, according to ASC 606, receipt really should be treated in the form of a non-cash consideration at fair value or selling price. So there are other scenarios here that would require further evaluation. But if the asset is to be remeasured for impairment, you'll also just want to take consideration of FASB ASC 820, which is the fair value measurement. So the last item that was interesting and wanted to bring up is that there's a new bill introduced in Congress back in August. It's the Digital Commodities Consumer Protection Act. And it would give the CFTC, or the Commodities Future Trading Commission, some oversight to regulate the trading of the digital commodities. And this would just add in another layer of regulation to what I just discussed here. So that's why I thought it was fairly interesting. So you have the SEC as well as the CFTC. All right. So the next topic I just wanted to highlight here briefly is from an IPO and SPAC perspective. I know there's not too many of that as much going on last year, but I think it's still worth talking about. So this scenario I wanted to just introduce. This is a relationship between the SPAC sponsor as well as the target company. And the target company here was charged with misleading claims about Momentus's technology and really failed to disclose that the only in-space test that failed to demonstrate the technology's commercial viability. And what added to the issue is that the SPAC entity also did not review the test results. And so as a result, the SPAC, the sponsor, and the target, all the parties, as well as relevant CEOs associated, were charged for misleading the disclosures. And this is where there's a lack of due diligence that led to this issue. And as a total, over $8 million in fines to all the parties involved, a reevaluation of the business, so the business valuation reduced to half. The merger proceeded once the case was settled with the SEC, but the valuation definitely had reduced. And then the former CEO of the target was forced to exit because also the SEC had the case pending specifically to him as well. All right, so IPOs and SPACs. And because of the significant volume of the transactions involving the SPACs back in 2021, the SEC also had issued a proposal in March of last year to enhance the disclosures for business combination transactions between SPACs and private operating companies, or the de-SPAC transactions, and to address the treatment involving reporting shell companies and provide additional guidance on the use of projections. So now there's been a bit of a slowdown with the increasing inflation and interest rates starting last year, but again, as I mentioned, I think it's still worth mentioning here. The SEC has proposed rules out on the SPACs, so you'll likely see some official position this year. But for the OCA consultations in prior years, the top issue identified was accounting for warrants. In 2021, over 3/4 of the restatements of the past financials were SPACs, according to the audit analytics, triggered by warrants. And for ASC 815-40, it really provides guidance to evaluate accounting for contract warrants by indexation and the equity classification criteria. And if the warrants don't meet those criteria, it really leads to a liability classification. And fair value input is also relevant in the analysis as specified in the standards. And then there may be unique scenarios that should be considered with other variables for evaluation. The DCF also previously emphasized the importance on the disclosure of the financial incentives of the SPAC sponsors to complete the transactions. It really just to understand if there's any potential conflicts of interest, risk to the shareholders, just bring that for awareness, who continues to hold the shares after the SPAC merges. And then you have the interest instrument to redeem. So it's temporary equity. It's also an area of concern. It's having to redeem either early or after the merger and having to classify it properly. So shares to redeem early should be classified as temporary, and redeemable equity feature for cash that's outside the control of the company should also be classified as temporary, since it's going to occur really when it's combined or dissolved. But the SEC has noted in the past that a number of companies have classified this as permanent equity, and see that companies may prefer to book this as permanent to have the minimal impact to the earnings per share, but it's really not the proper treatment. So you want to refer to the guidance for more details on that. Now the other topics, here's the cybersecurity proposed rule, which I think many of you have interest in as well. And so another significant proposal in March last year, the SEC had proposed rules and amendments to enhance and standardize the disclosures around cybersecurity risk management, strategy, governance, and incident reporting by public companies. And to expand a bit more, the requirements include amending the Form 8K to report on material cybersecurity instances within 4 business days of confirming the materiality. So not based on the discovery date, but once you confirm that's material. And then disclosing the policies and procedures, the management's role, the board of directors' expertise on how the entities ID and manage the cybersecurity risk, and reporting on prior material incidents. Now, the element that may take some effort for entities to define and agree to is what classifies as a material cybersecurity incident to report. And the SEC proposal provides a few examples, but it is up to the entity or the organization to interpret and likely to define that in their policies and procedures. But a few examples they have include unauthorized incident that caused degradation, interruption, loss of control, damage to or a loss of operational technology systems, an incident in which an unauthorized party accessed or a party exceeded authorized access, altered or has stolen sensitive business information, or an incident which a malicious actor has offered to sell or has threatened to publicly disclose sensitive information and is demanding for payment. So those are a number of material incidents that may have occurred that the SEC have included as examples. Now with that, we have our next polling question. So with the next polling question, are you currently aware of the top trends from the SEC comment letter feedback to public companies this past year? So it's a quick polling question, but I am also just curious in terms of if you're aware of the top trends from the SEC. And we'll just give it a little bit of time. Okay, there's a significant number of you. Well, this is great. Great transition into the topic then, if you're not aware of that. Move to the next slide. There. All right. So this is the next highlight. Wanted just to highlight a few things here. And so, as I mentioned before, the DCF, SEC's DCF, staff and team issued these comment letters. And so the SEC has focused on issued a number of comment letters as they review companies every 3 years. And these are the key themes that was around, and actually it was the SEC along with other panelists. And so I do have references in terms of the resources there. But really, the DCF has shared some of the key themes around the MD&A, non-GAAP disclosures, and segment reporting during the conference in December. And there's been a high volume of comments related to MD&A, and some of the common themes really is around the results of the operations and critical accounting estimates. And I have to say, also, the trigger, it has also been because there were the amendments to the regulation SK, which is heavily MD&A focused, and it became effective 2021 to modernize and enhance the disclosures, but since then, since the last 2 years, MD&A has been fairly high in the list. So it's a really key reason why the comments, if the entity is not clear in terms of the specifics on the implementation, that would trigger the comments as a result. And for non-GAAP disclosures, the themes observed here really is the prominence of the non-GAAP measures, and the SEC referred to the compliance and disclosure interpretations example and guidance about non-GAAP measures. And so really explaining that when a registrant presents a non-GAAP measure, it must present the most directly comparable GAAP measure with equal or greater prominence. And so the key point is that the GAAP is the foundation and really should still be the focus. The other is mislabeling of measures. And so one example is shared with the labeling of contribution margin, a non-GAAP measure that's used in place of gross margin. And so you want to be cautious and careful in terms of what measures that you're disclosing and communicating. The other is performance metrics. If the metrics are included, disclosures should also be included, such as the clear definition of the metric and how it is calculated, and the statement indicating the reasons why the metric provides useful information to the investors. And then the statement indicating how management uses the metric in managing or monitoring the performance of the business. The DCF communicated the importance of being consistent on how metrics are calculated, as well as maintaining proper controls and procedures. And the Commission also have provided guidance on this topic, which I believe I have the hyperlink in there as well. And then for segment reporting, the DCF has communicated common themes that raise concerns. One is the identification of operating segments, as the operating segment should be tied to the entity's decision makers about operating matters. And then the DCF indicated that the staff are likely to comment when the entity has only one reportable segment, but when there's been changes in the business structure shared publicly, such as earnings or just press release and things of that sort. And then there's the aggregation of the operating segments, criteria and quantitative thresholds defined from ASC 280 needs to be considered to determine whether to aggregate operating segments into reportable segments presented. And then changes in the reportable segment. So if the composition of the segment changed, entities should restate the segment information from prior periods for consistency. And then the DCF also provides feedback on requiring enhancements on entity-wide information. They also note that, it's really important to include, it's really important in terms of publicly available information that's provided. The SEC staff considers all publicly available information when reviewing their registrants' filings, such as earnings calls, websites, analyst presentations. And then I have this next one to discuss from for our risk management audience here, for internal controls over financial reporting. This was also a top theme, this number 7, but it's still also a top theme that's been observed here as well. And so the themes include evaluating the severity of the control deficiencies, not just individually, but in aggregate when there are multiple or in context, such as triggering an immaterial restatement. Are the deficiencies appropriately identified in the COSO components other than the control activities? Disclosure of the material changes, so not just using boilerplate disclosures suggesting no changes, or if there's a material weakness that's been noted, but it doesn't contain enough information to be understood. Conclusions on ICFR after a restatement. Since a restatement typically is a sign of a material weakness in ICFR, even if the restatement is immaterial. And then missing ICFR evaluations. So those are just some of the highlights on top comment letter trends. Just wanted to share here. And we're getting close towards the end. So, I just wanted to share this with you that ICFR is very important. And so in this scenario, the lack of ICFR really caused the company to have the SEC look into this further. The company was fined, and then the company was also required to have the financials restated. But I wanted to at least save a little bit of time for PCAOB updates. And before we do that, we have our last polling question. And the last polling question here is, besides financial statement matters, what other areas did the PCAOB increase inspection focus? And the options are IPOs, accounting for digital assets, risk assessment and fraud, or all of the above. Give it just a little bit of time for the response. And we'll save really the last 5 minutes or so to highlight on the PCAOB updates. Great, all of the above. And for those of you answered all of the above, then yes, that's correct. The PCAOB is focused on all of them. So just as a quick note in terms of the PCAOB objectives, the PCAOB inspects over 200 audit firms and reviews over 800 audits on average annually across the globe to ensure firms or the external auditors are following the PCAOB standards. And so the PCAOB's focus is really on the audit firms. Now, I wanted to just highlight a few things. Recent activity, PCAOB recently issued a standard on supervision of audits involving other auditors and the dividing responsibilities for audit with another accounting firm. So it may not necessarily apply to you if you're working from an internal audit perspective, but it's just for awareness in terms of their most recent standard setting activities. Now, in terms of inspection focus and target areas for 2022, I wanted just to highlight here, you have the financial statement items that typically is there, but then you also have other activities such as the risk assessment, fraud, and crypto assets. And then they also have other target areas such as the climate change, as well as IPOs. So from a risk assessment and fraud perspective, I just want to highlight that they are focusing on having to understand business, wanting to understand from business at a granular level, and being aware of the pressures on the company's management to have results appear more favorable, taking those aspects into consideration. And then also having to see if companies are identifying new audit, or firms identify new audit risk, which requires revision of prior responses. In terms of crypto assets, it's having to select issuer audits where transactions in the crypto assets are material to the financials. Now, I do have 2 slides I wanted to share, but I think what might be the most relevant here is wanting to talk about other deficiencies, which includes the critical audit matters and audit committee communications. And so in terms of, for CANs, the most deficiencies identified were instances where the auditor procedures to determine CANs did not include all the matters that should be analyzed as potential CANs, and other instances did not include clear description of the CAN. And then for audit committee communications, some of the common deficiencies include no communications of names, locations, or responsibilities of the different firms and engagement team members. And then also no communications of critical accounting policies and practices used by the public company, including the reasons why certain policies and procedures are considered critical. And the last one is not having copies of the management representation letters which is a very material written communications between management and the auditors. So those were some of the deficiencies observed. And then lastly, I wanted to kind of close out on these top areas, the percentage of total ICFR audit deficiencies by nature. And you can see here, especially for the right, you can see the nature of the causes for where PCAOB had identified as a deficiency, with here A, B, and C as the largest. So I think this would be relevant for some of the risk management attendees here and be of interest in looking at that a little bit further. And I also have the link and reference in terms of the PCAOB staff communication as well. So with that, I think this wraps up our technical accounting update presentation. And I thank you for your time and participation in the session. And please feel free to reach out to me. Here's my contact information if you have any specific questions. Thank you, and this concludes our presentation.